AGC Georgia has prided itself for many, many years as being a source to help the contractors in the construction industry in their operations. We find that if we can help y'all be more productive, eliminate waste, and provide best new practices, then you certainly have a greater opportunity to improve your profitability. Additionally, the industry right now is going through a little bit of a resurgence, which is great, but that's putting pressures on people to find employees and keep key employees. And clearly in our industry, one of the things that would help us the most is have a good competitive benefits plan. A lot of regulatory rules in the area of providing benefits, and that's a constant changing in the marketplace. I suspect our new Congress will not let another year go by that they don't do some changes in the rules and regs. And we'll do our very best to make sure the industry are aware of those. We find this would be a good time to have a refresher on your 401k programs and particularly look at what you're doing for your employees. And if you haven't got into that arena, know more about what you need to be doing to be competitive. To answer that, a couple of years ago, we created our own multiple employer plan, which rolled up our members into a very competitive program. And this is not intended to be an infomercial, so we won't talk much about that. But we will get in very quickly to the do's and don'ts of a plan that are very important. Let me get right to it and introduce our panelists. I think you can see their backgrounds, but Bob Christensen is a partner with Fisher and Phillips. Bob has been a tremendous source for me personally, and I want to thank Bob for doing that. His firm's been a leader in the benefits law area, and he specializes in ERISA practices, and Bob gives us great insight to what we need to be doing here at the chapter. Don Ford with Pinnacle Financial Services. Don is an expert in his field of pension consulting and third-party administration. We brought Don's firm on board to help us in the administration of our plan, and I can tell you they've done an outstanding job, and I really do appreciate Don for what he's done for us. And Linda Smith, she's the founder of BenSource, which specializes in providing retirement plans and group insurance benefits. Linda's been with the chapter since 1995 as she was working on the AGC's plan as a single employer plan, and has been instrumental in helping us get to where we are today, where our multi-employer plan. She does a great job of helping the administrators inside offices set up and work through the process, but she also does a tremendous job in training. So with that, I want to give our panelists plenty of time to give their presentations, and then at the end, hopefully we might have a few questions. So first I'm going to call on Don. Don Ford, if you would please, take us through your presentation. Don, can you hear me? Don, can you hear me? Bob, can you hear me? Bob, how about it? Are you there? Well, if you're in the sound of my voice, we're having just a couple of technical things. Bear with us, please.
Bob, are you there?
Yeah, can you hear me?
Yeah. Yeah, and Don, are you there?
I'm here.
Okay, Don, great.
Well, you can hear me now?
Yeah, I got you now. Thank you so much.
No problem. I was talking, but you guys couldn't hear me.
Well, good.
Anyway,
Well, Don, if you would, please start your presentation. Thank you so much.
Okay, happy to. Pinnacle Financial Services is a third-party administrator, And third-party administrators in many cases are like the man curtain. People don't really understand what we do. You know, Transamerica is the investment provider. You know, Linda and her group, PenSource, is your financial advisor, and they come out and visit with your participants. But the TPA does stuff sort of behind the scenes. So what I wanted to do is run through a few of the things that we do and how we help you and how we help the plan. And so if you would back up the slide back to the original. So as a third-party administrator, we have functions with participants, with you as the employer, and with the AGC itself as plan sponsor. So go ahead to the next slide. For the participant, what we do is we assist them in getting loans and distributions from the plan. So they'll go direct to Transamerica to make application for the loan. But then we provide additional information. We work back and forth with Transamerica to verify that the participant's loan is calculated correctly, that they're eligible for the loan. Same thing with distributions. We're looking at vesting. We're looking to make sure that the amount that is distributed out to your participants is accurate. Now, we do have direct contact with your participants, and I have listed on there our email, client services at pfslink-e.com, as well as a direct dial phone number, 561-547-4200. When they dial that number, they go directly into client services, and anyone who will answer the phone would be capable of helping them. Our client services department answers general questions, non-investment related questions. Those types of questions would go to Linda and her group. Next slide. Now, we help you as an employer with regard to your payroll processing, and we're going to talk a bit more extensively about that later in the presentation. We also do match and profit sharing calculations for you, and then at year end we do all of the non-discrimination testing. Next slide. One of the services that we can provide to you is plan design consultation. If you contact us, we'll review your current plan design with you, and we'll make suggestions based on what you tell us are your main objectives. And different employers have different objectives. Your objective may be to benefit primarily owners and other highly compensated employees. It may be to benefit middle managers. It may be a broad benefit across your entire company. So our first step in the consultation is to determine what it is that you want. Then we'll help you review your current design. We'll look at safe harbor, automatic enrollment, compensation adjustments, profit sharing projections. Essentially what we're going to do is make your plan design as efficient as it can be in order to achieve the goals that you tell us that you want. Next slide. Okay, for the AGC itself, what Pinnacle does is it prepares all of the year-end financial statements. So we reconcile all of the participant accounts and then prepare the financial statements. We prepare signature-ready Form 5500s, and then, of course, those go to the CPA for independent audit. And then we prepare a report that the government requires called the Summary Annual Report. We also, on an ongoing basis, prepare and review notices and disclosures for all of the plans. And then finally, we do compliance consultation and assistance. So if there's issues with respect to testing, issues with respect to plan document questions, those are things that come to us. Next slide, please. Now, the area that I wanted to emphasize in this is the processing, because there's strict guidelines that are in place from the Department of Labor. So with the AGC Georgia plan, what is required is that payroll contributions are submitted to us on a per pay period basis. And the Department of Labor's regulations provide a safe harbor. If your money is deposited into the plan within 7 business days of the date of the check, then they say it's timely. If it goes in later than that, then it's not timely, and they're going to charge you interest and potentially a penalty. With the AGC Georgia plan, the requirement in order to make sure that we meet that DOL safe harbor is that the payroll should be processed into our secure website either on the day of the payroll or the next business day following the payroll. Next slide, please. Now, why do we do this? Well, there's multiple reasons. There's some significant advantages to pay period processing. Number one, the information is required in order to send enrollment kits and notices out to participants. You're going to have new participants coming on based on whatever your eligibility criteria is. They need to get those materials on a timely basis in order to meet the DOL requirements. It also allows Pinnacle to provide you with interim non-discrimination tests. And so if you want to see how you're doing, are you going to pass your tests at year end, all you need to do is give us a call and we can print out a test for you in a matter of 10, 15 minutes. Finally, it tracks hours, wages, and contributions for participant loans and distributions. This allows us to help ensure that the loan and distribution process operates correctly and that any mistakes are avoided. Next slide, please. So what's required in the payroll processing? It's what I call the 3 C's. It has to be complete, correct, and consistent. What is required is all data for all employees that receive payroll during that pay period. That's complete. Correct is self-evident. We need to make sure that the data that's being supplied to us is correct. And then consistent. What Pinnacle is looking for is a data file in an Excel-style format. And the data should be consistent from pay period to pay period with regard to the format. Now, one of the services that we offer you, and Linda's group assists with this as well, is we'll help you establish your initial file format so that it is being submitted on a complete basis and being submitted on a consistent basis. We have IT department here. They can help write programs to extract the data from your payroll processing software. Next slide. So just as a quick recap on the pay period processing, the reason this is so important is the Department of Labor has this as a major focus of enforcement. One of the first things that they look at is show us all your payroll records and show us when the deposits were. So we want to make sure that we have that those deposits into the plan within that DOL safe harbor period. And the way that we do that is the AGC has set up guidelines for you. The payroll needs to be submitted through Pinnacle either on the day of the pay cycle or the first business day following the pay cycle. So that's my presentation. I'm going to hand it back to you.
Wonderful. Well, thank you, Don. Appreciate that. Next, I'd like to call on Bob to touch on a few of the issues that are very important as it comes to bear with other legal requirements. Bob?
Yeah, thank you very much, Mike. As Mike said, Fisher & Phillips has helped out the AGC for a number of years now with the legal aspects of all this, and I think basically where we come in, I think with the universe of TPAs like Don or the advisors like Linda is we try to tell you what you can do and what you can't do. And so one of the things I think that Don was talking about was, he likes to go in and help people. He finds out what their goals are and then helps them design their plans. And we help with that process as far as the legal aspects of that are concerned. One of those design features is something I think that's near and dear to a lot of construction industry employers' hearts, and that is that in some cases you really don't need to have a 401k plan for all of your particular businesses. For example, you may want to have a 401k for your operating subsidiary, but if you have a subsidiary that that, for example, leases equipment or leases property or something like that, you may have those people that are employees of that subsidiary to participate. And so one of the things that we do, I guess, is help with that process. And I want to talk a little bit today about what that process is, and specifically control groups and separate lines of businesses. Really try to tell you how you can set up your operation so that you don't have everybody participating. Now, the reason this is a problem is because the IRS looks at all closely related companies, and Department of Labor also, as a single employer. You may have separate corporations, separate LLPs, however you're particularly structured, but if they're closely enough related so that they're part of what's called a control group, then IRS considers, and DOL considers all those employees to be the employees of a single employer. So if you have a 401k for only one of your companies but not the other, in some cases they will be considering employees that are not participating in testing and some of the issues with respect to the plan. So you kind of have to be careful about that. There's a couple types. Well, one of the things I wanted to make clear before we get into the control group issue, when you essentially implement one of these 401k plans, you sign what's called an adoption agreement. You may be familiar with that. It's a maybe a 20 or 30 page checklist of items where you check to determine what kind of features you want in the plan, and that's the kind of thing that Don would be helping you with. You have to be very careful with these adoption agreements because they're very technical, and in some cases the adoption agreement simply assumes that all of your employees are going to be participating, even though that's not what you really have in mind. So I have the adoption agreement on the slide here simply because I want to remind everybody to be very careful when you sign up these adoption agreements to make sure that you have your corporate structure exactly as you want it, and you have the employees of particular entities participating or not participating. You have to be very express about that. There's a couple different types of control groups, and these are the entities that are so closely related that IRS and DOL is going to consider them a single employer. The one that I'm going to talk about today is a parent subsidiary because that's kind of the simpler approach. I'm also going to talk briefly about separate lines of business, but that really applies only to larger employers because you need to have 50 employees in each of your separate lines of businesses in order to do that. Could you change the slide for me, please? Okay, this is a simple example of what is a parent subsidiary control group. Basically, you're part of a parent subsidiary control group if a common parent owns 80% or more of each entity. Now, if you look at owner 1 here on this slide, you see that it owns 100% of corporations or whatever entity they might be. A and B, an individual, for example, who simply owns 100% of the stock in those entities. A and B would be part of the control group. Entity C is also part of the control group because A owns 80%. So even though owner 1 might not have any stock in C, the fact that he owns 100% of A, which then owns 80% of C, is enough to put it within the control group. Now, if you look over on the other side and you see B and D, you'll notice B, of course, has 100% ownership, so it's in the control group. But D only has 75% ownership. D is not going to be part of the control group. So this shows one way potentially you could set up your entities to have one entity outside the control group, but owner 1 is still going to really control what goes on there. Owner 2 in this case would be unrelated. And one of the things I wanted to mention is that these don't have to be corporations. These can be partnerships, they can be proprietorships, they can be whatever. But the same kind of rule applies. Second slide, please. Now, this shows another situation with a parent subsidiary control group. The owner owns 100% of the stock of Corporation A, but the owner's spouse or minor child owns 100% of B. So you would look at that and say, well, they're part of a separate control group because somebody else owns it. Well, that's not the case. For purposes of the IRS rules, they apply what's called attribution, and that means that a spouse or a minor child's ownership interest is attributed to another person, in this case the owner, another person's ownership. So the way the IRS or Department of Labor would look at this is that both A and B are 100% owned by the owner, even though he or she may not have any stock directly in B. Now, another situation that gets you at the same place. Suppose the the owner of B was totally unrelated, but the owner of A had an option to buy out the owner of B. In that case, those shares again are going to be attributed to A. So you have to be very careful with how you set these things up. Can you go to the next slide, please? Okay, now this shows, again, this shows you how you can set something up so that there is no control group. Obviously, A is going to be part of it, but as long as owner 1 only owns 75% of B, and owner 2 is an independent person, an adult child, for example, would be okay. Then that's going to be outside. Entity B is going to be outside the control group. So what you have here, effectively, the owner of owner 1, can control things, but they're not part of the control group. So the employees in B would not have to be part of a 401k that the employees of A participate in. Next slide, please. Okay, now I told you there's a thing called a separate line of business, and this allows entities that are part of the control group to be tested separately for purposes of 401k rules. The kicker here is that each one of these locations, or each one of the members of the separate line of business, have to have at least 50 employees. Other than that, you can set this up pretty much as you like. You can identify a separate line of business by location or by the type of services that the different companies provide. You have to have a bona fide business reason to do this, other than simply you don't want them participating in your 401k. The entities need to be organized separately, but they don't have to be separate corporations or anything like that. They can be divisions of one corporation. But you have to account for the profits separately. They have to have workforces, and they have to have separate management. So that's a tool that can be used as your companies grow, and we find it pretty handy in situations where there are multiple types of employers that are related through a control group. Okay, could you go to the next slide, please? All right, this is the other issue that I wanted to talk about was what are IRS and DOL doing with respect to these plans? And this is where somebody like Don and Linda can come in very handy for you, because they really, the bottom line is that as a business owner, you're running your business. You're not running you're not a professional 401k administrator like Don might be, or investment advisor like Linda might be. And the things that you do, you're good at what you do, but you may not be so good at running a 401k plan. You may not have any experience in doing that. The IRS and the Department of Labor don't really care. They sort of take the worldview that as an owner sponsoring one of these plans, you are held to very high standards of how your plan is put together and how your plan is run. So they have aggressive audit programs, and I think that's the only way to describe it, is aggressive. These things can be triggered by employee complaints, which is probably the biggest trigger for audits, or if you file your 5500 and answer some questions incorrectly on that 5500, then that also will trigger an audit. And then sometimes there's simply random audits, although those are, we don't encounter those very often. But the Department of Labor has an office right here in Atlanta that does nothing but conduct audits of employers' 401k plans. And the problem, quite frankly, is that these plans are so complex, as you probably understand from just listening to a little bit about what's been talked about today, that it's virtually impossible to run one without having some errors. And so, we all try not to have errors in our 401k plans, but I'll be perfectly frank with you, Fisher & Phillips has them. We find them every month, even though we have a bunch of lawyers who are supposedly looking over this stuff. So it's really a difficult situation. Now, one of the things Don mentioned, I think, was that was the first thing that both the IRS and the Department of Labor look at, and that's That's how timely are your contributions. Normally, unless you have a program where you're very, very careful with your contributions, things happen. Employees and payroll leave. Somebody's sick the week the payroll goes out. There's always some kind of screwy thing that happens that will delay payroll to the point where the Department of Labor or IRS would say that's unacceptable, and then they potentially can fine you, and they'll, at the very least, they'll require you to pay interest to the employees whose monies did not go in timely. The Department of Labor is particularly interested about what's called fiduciary due diligence. And that means that you as plan sponsors, or really as the officers of companies, have a duty to plan solely in the interest of participants and for the exclusive purpose of providing benefits and paying reasonable administrative expenses. Then you're also charged with operating the plans in a prudent manner, just as somebody who essentially was an expert in 401ks would be running it. So what this means, of course, is that you can't just say, hey, my brother-in-law, the broker, is taking care of all this stuff, because your brother-in-law, the broker, may not be looking out for your best interests and may not be as knowledgeable in this situation as you think he might be or she might be. When the Department of Labor comes in, they also look at plan compliance issues and IRS as well. That means your documents have to be current. That means that you're following the terms of your plan with respect to, for example, granting loans or considering what types of compensation are considered compensation under the plan. Your 5500s are accurate. You've been giving the proper notices to employees. Your summary annual report, one of the documents that Don said that they provide, is up to date and has been distributed, and your summary plan description is up to date and been distributed. These things can, these things can get very complicated, and that's why it's good to have somebody helping you out that really is a professional in the field. Finally, the other thing that they look at a lot are plan expenses, and this is something that's really becoming a hot button in Washington. That is that the investment accounts that you have under your plan cannot charge unreasonable fees, or you can't charge fees for overhead or administrative expenses that aren't reasonable. Loan fees can't be unreasonable, or withdrawal fees, for example, expense loads on your investments. All those things are things that you need to be very careful about. The bottom line, I think, here is, my last bullet point is compliance and cash. And that's kind of if you wanted to know what the difference is between an IRS audit and a Department of Labor audit, unless there's something really screwy going on, the Department of Labor is going to just simply go in and tell you, look, you need to correct these things and tell you what you have to correct. If it involves, people who have not been participating as they should, or late compliance or late contributions, then they'll have you make some additional contributions to the plan. But generally, unless there's some real malfeasance, they're going to give you a pass and say, you correct these things and we're happy. Department of Labor, or the IRS rather, is completely different. The IRS is in it for cash, and they are solely in there. I mean, they're obviously looking for compliance, but if they find something wrong, they are gonna nail you with a fine. That's what they do, and they are, again, very, very active. So it's very good when you get a notice of an IRS audit coming up. It's almost imperative on you. Well, for the same thing for a Department of Labor audit, but it's imperative to start talking to people and make sure you go through your records and have someone look at your records to make sure that that your compliance is where it needs to be. So otherwise, you can face some stiff penalties, and believe me, I have seen penalties ranging up in the millions of dollars. I'm not kidding about stiff penalties for smaller plans. So you need to be careful with these. That's what I have to say. Linda, I guess you're next, right?
Yeah, thank you, Bob. Great points, and if I could just encourage more business owners to seek the assistance of a competent attorney like Bob, especially when you're starting a new company. Before you get those corporate agreements hashed out, talk with someone like Bob to see how it's going to affect your 401k plan. Almost every year I encounter a new employer who finds himself in a position where they are a controlled group and they were not administering their plan properly. So in this case, it's definitely wise to seek the advice of an attorney before you start your ancillary companies. So my section of the program I'm going to try to go through real quick so we can actually jump to questions and answers. A lot of the stuff that I talk about you may have already heard because your advisor is the one that you talk most frequently with on a day-to-day basis. So I'll jump right to the what's going on in Washington. So as you look at this picture, it evokes a sense of fear in everyone that when Congress is in, we need to hold on to our wallets. But I do want to say that contrary to any hype you might hear, Congress is not devising a way to tax your 401k or your IRA. However, they are acutely aware that Social Security cannot sustain a human on its own, and they're also aware that Americans are not saving outside of Social Security. So what they are devising are clever ways to boost the way that Americans do save. If you listened to the most recent State of the Union address, you heard President Obama talk about the MyRA. This is actually an employer mandate. It's just a proposal right now, but it's definitely got bipartisan support. And the mandate would require that employers with as few as 5 employees offer establish IRA accounts for every employee and facilitate what we call a negative enrollment, which is that the employee would be signed up for a 3% contribution unless they opt out. Illinois just passed a law, so it is now law in Illinois that employers with greater than 25 employees and no qualified plan establish a retirement plan and also establish a mandatory participation by the employee. The employee can opt out. But the important thing about this particular thing is it's a law. It's been passed. In 2 years it goes into effect, and there is a fine per employee for every employer who does not establish this plan. The biggest difference between these two plans is that Illinois, the investments will be private companies, similar to what you see if you have a 529 plan. The state will choose one vendor to provide the investments, and then they will review that investor or that investment provider every few years and replace that investment provider if a more suitable one comes along. The federal proposal would not do that. The money would go into the federal treasury to be invested only in U.S. government bonds. So that particular part on the top is a little bit disconcerting to a lot of people. My personal opinion is that we will end up going more the way of state-mandated programs. So we can talk about increasing participation. That's the other thing that we wanted to touch on. Does this picture look like you? Does this picture kind of what you face when you try to get your employees enrolled in your plan? Or maybe even this? These are funny images, but the reality is that in my 20-plus years of doing this, I have watched participation rates drop significantly, and I just see that Americans are woefully unprepared for later on in life. So what we have come across that has become incredibly popular, or I would say incredibly efficient with construction companies, where we don't always have access to the employees. A lot of times they're out in the field and it's just not feasible to have meetings and such, is tapping into what's called automatic enrollment. I will say that this idea takes some warming up to, but I would suggest that you keep an open mind with this. We've seen great success with it, and that if you haven't looked at automatic enrollment in a while, it's been completely modernized. First of all, you're handing out notices anyway, so the automatic enrollment notice is just another notice that goes in that 30-day prior packet and the opt-out period. I would strongly suggest starting very small at a 2% rate. The more popular option is 3%, but I've found greater success in 2%. You have a guy earning $1,000 a week, that's $20 a week on a pre-tax basis. I can usually get him to buy into that. This particular automatic enrollment provision also has a 90-day money-back guarantee on it. So if the employee doesn't like it in the first 90 days, they get all their money back. We market it as a test drive, and it's very successful. I'll show you the next slide in a moment that the proof is really in the numbers. And if you are working with a firm like Don's, I don't know that he really drove home how efficient that full data processing is, but whereas you usually are just sending in name, social security number, and dollars, with Don's process, you send in a bigger payroll file. They track your eligibility. So they're the ones that are providing the notices to your employees mailed to their home address. So from the very beginning of automatic enrollment, they are handling the process. And then if the employee calls to get their money back, that's handled directly by the vendor. The vendor sends the check to the employee. The vendor does the 1099. So the only roles left for your HR person in this whole particular automatic enrollment process are going to be to receive the payroll deduction instructions and pay attention to any payroll deduction instructions where an employee might subsequently opt out. But when you have a firm like Don's on board, they are truly doing all the work and driven by that data file. I've also had a lot of success with off on the automatic increase until year 2 or year 3. So you give people a couple of years to get acclimated to it. Without fail, 100% of the time, the common replies I hear from business owners after they establish this, number 1, I should have done this 5 years ago, and number 2, I'm astonished at how many people stayed in and did not opt out. So let's take a look at the payoff. These are my actual experiences. This is a 140-person electrical contractor. These are your subcontractors. So we started out with a participation rate around 15%, and then you know that compliance test that a firm like Don does at the end of the year. This particular contractor had a 0.79 average deferral rate on the non-highly compensated, and you know what that means, that the highly compensated can only do about 2% more. So 2.79% does not make a highly compensated person happy. After we installed automatic enrollment, 84% of people were enrolled. 2 years later, I still have 72% of people enrolling. This stuff works, and it does the job. I'm here to tell you that you do not have to do additional matching to lure people into your plan. You don't have to do fancy brochures. You don't have to do more educational meetings, although they do help. This is a magic bullet right here. And you can see that that ADP test for the HCEs 2 years later at 6%. That's pretty astonishing. This is a general contractor. Before we had 35% participation. After we had 90%. And then 2 years later, the participation's even higher because we don't make this big a deal about it. So the automatic enrollment just sort of takes effect, and we don't necessarily advertise for how people can opt out. They receive the information and are certainly given the opportunity, but we don't advertise, and it sticks. With this particular general contractor, they're at 9% with their ADP for HCEs. That's pretty amazing. Let's talk a minute about Davis-Bacon. If you are a general contractor, you're probably not highly exposed to this, but your subcontractors are. So I would definitely encourage you to talk with your subcontractors about this. Get them to call me. We do free consultations over the phone. But if they incorporate this into their bid, it's going to directly pass through to your bid and could save as anywhere from 5 to 8% line item off of your bid. So the Davis-Bacon Act was the law that was passed to level the playing field between non-union. It required that the non-union contractor had to increase his wage to cover the fringe benefits, one of those being retirement savings. The difference is that in the union, there was mandatory participation for the employees. The union took the money out of their paycheck and they used it to purchase those fringe benefits. The non-union, the private employer, is paying that fringe wage out to the employee in cash, and the employee is not turning around and using it to fund retirement savings. So what's become popular is you can actually require that that fringe wage be diverted into a 401k account for that participant. It's kind of an amazing tool. The money does not even enter the employee's payroll, so it completely escapes payroll taxes for both the employer and the employee. The employee, in the end, withdraws the money without ever paying taxes on it. So you know how much payroll taxes are. Let me take you through this quick chart calculation. This is an actual mechanical contractor that we work with. Here are the job classifications, and at any given time, these are the number of employees that they have. We took this information from 2013, actually. So these are the number of employees they have in those areas. This is the fringe wage. This is what's paid on top of the base wage that they usually pay that plumber. And when you multiply that times a 40-hour week, that plumber is receiving $469 per week in additional pay, and that he's not turning around and putting it in his retirement plan. I can just tell you that. But on top of that, these are the taxes that the employer is paying on the week. And then when you multiply it out, what the employer pays per year times the number of employees in that role, and you add it up, this was the FICA savings for this employer who diverted the fringe to the 401k. And the warm fuzzy on this is that a lot of these guys never would have saved for retirement. All of a sudden, they get a quarterly statement at their home address, and they're saving for retirement. And this is the kind of stuff that we try to use to convince employees of where they need to be going. In closing, I just want to say, when people envision retirement, this is what they envision, but the reality is this is what retirement looks like. This is what old age looks like. And this is what our employees are facing, are not prepared for it. So as much as you want to, I talked with one employer about the automatic enrollment, and he said, oh no, you don't mess with a man's pay. And I said, but he's going to be messing with yours. If you don't take these proactive steps to encourage strongly your employees to get involved in saving for old age, he's going to be tapping into, he's going to increase your taxes because he's going to be on a welfare program to take care of him. He's also going to be still working for you and driving up your health care costs. So it pays for you to take an active role in encouraging these folks to save for later on. There's my phone number. We give free consultations. And last, you don't want to look out your window and see your employees in this state. All of us want to look out and know that our employees have done what they needed to do year by year and taken the steps so that they can actually enjoy their older years. So with that, I think, Mike, do you want to open it up to...
Absolutely. I want to start off by thanking our panel for their comments, and we're going to provide, I think, a tremendous report, 2014 industry report. It's rather lengthy, but it does comprehensively talk about what the industry is doing in the area of benefits that I think you'll find of interest. And I'll open it up to anyone that might be with us that has a question of any of our panelists. Anybody have a question? Oh, I had one that I wanted to reconfirm, as I understand it. Don, is 2015 the year that restatements of everyone's plan is due, and what does that entail?
Okay. We actually have until a little bit later in 2016, but we're going to be doing the restatements this year. And what will need to occur is new adoption agreements will need to be executed by each one of the participating employers in the plan. There's going to be a general restatement of the base plan that the AGC itself will take care of, and then we're going to be contacting on an ongoing basis all of the participating employers, updating all the information, making sure that the plan provisions are what they want going forward, and then new adoption agreements will be prepared, and we need signatures.
One of the good things about that restatement cost is it's borne by the plan but not the individual participating firms. Is that correct?
That's correct.
One of the things that's good about the plan as we set it up was to have the people participate and avoid quite a bit of that individual cost. I had a question, Bob. You touched on the liability of trustees and their responsibilities. If they have a single employer plan, what typically is the view of how much participation they have to give? Is it set on autopilot and they look at it once a year, or what is a standard that DOL and the IRS would look at?
Well, it depends on what kind of discrimination rules you're looking at, but generally if you have 70% or so participation, you should be okay. The test that Linda was pointing out there, the deferral tests that really show you how much the more highly compensated people can contribute, that's the one that's probably the most important. And that's why it's good to get as much participation as you can and keep that contribution rate up, because that allows the more highly compensated folks who really are trying to put some money away, it allows them to maximize their contributions.
Bob, this is Linda. I have a question for you regarding that controlled group conversation. Back when you were showing that slide, and we're going to make the slides available to everyone. Back when you were showing that slide where the spouse could own 100% of a different company, and it could be, or an adult child could, and then it would not be a controlled group. Does that get complicated when the adult child works or receives compensation from both companies?
No, it's really an ownership issue as much as anything, but I do want to clarify that the spouse's ownership is going to be attributed to the other spouse. So if a spouse owns 100% of a company, if the two spouses own 100% of separate companies, they're going to be considered to be one controlled group. An adult child is different. There is no attribution with an adult child.
So if I'm a general contractor and I have a 401k plan for my 20 employees and my spouse is an interior contractor and they have a company with 10 employees, are you saying that we're a controlled group?
Potentially, yes.
Okay.
Those are some of the little surprises. Now, you know, the other side of this, excuse me, control group thing that's a real problem comes in when you're if you're in a union multi-employer pension plan, because there, if you contribute to those plans, these other entities are going to be considered an employer along with you, and you could accidentally trigger withdrawal liability if you do the wrong things.
Okay, interesting.
Are there any questions from any of those that have joined us for the webinar today? We are approaching the end of the hour, and I want to again thank our panelists for taking time to be with us this morning, preparing their slides. As Linda said, we will provide folks the opportunity to have these slides, to go back over them at their leisure, and at any time, if we can be of help at AGC Georgia or any of our panelists, I know that they would be very much available to you. And this is an area, quite a bit of scrutiny, as you've heard from our panelists, quite a lot of moving parts. And so if at any point in time in the future AGC can help you in this arena, hesitate to call on us.